Ever get the feeling that the world of finance is this massive, intricate machine humming away, just out of sight? Today, we're going to try and get a much clearer look under the hood, specifically at central banking and the financial markets.
We have a truly insightful resource to guide us today, Central Banking 101 by Joseph Wang. And what makes this so valuable, I think, is that Wang wasn't just an observer. He worked right at the Federal Reserve's trading desk, the desk.
Ah, right, the desk.
So this isn't just abstract theory. It's a real-world perspective on how the system operates, with some surprising details, actually, even for people in the industry.
Exactly. It's an insider's account of how everything actually works. And you were curious about getting down to those fundamental mechanisms. So our goal in this deep dive is to give you a much sharper understanding of the different kinds of money we use, how they come into being, and the critical roles played by institutions like, well, Federal Reserve, obviously, but also these entities known as shadow banks. We're going to take this step by step, focusing on the essential ideas and hopefully those aha moments. You shared this because you want to grasp the basics, so let's break it all down.
Absolutely. Let's begin with something we all interact with daily: money itself.
Okay, so the first thing that comes to mind for most of us when we think about money is probably those paper bills printed by the government fiat currency, with all the historical figures on them. It's backed by the government, right?
That's the most tangible form we see, definitely. But within the financial system, there are other critical types. One key one is central bank reserves. Think of these as a special kind of digital IOU from the Fed directly to commercial banks.
Okay, an IOU to banks.
Right. For a bank, these reserves are as good as physical currency. They can always exchange them with the Fed for cash and vice versa. No problem there.
So it's like a high-powered digital cash system just for banks. Is that a fair way to put it?
Precisely. Yeah, that works. Banks use these reserves when they make payments to each other or to anyone who holds an account directly at the Federal Reserve, like the Treasury Department.
Got it.
Now, here's where it gets really interesting for how our everyday money works. Bank deposits. There's a common assumption, right, that when we deposit money in a bank, the bank then lends that exact same money out to someone else.
Right, it feels like they're just holding our money and then passing it on, like intermediaries.
But according to Wang, the reality is quite different. Banks actually create deposits, essentially. Well, out of thin air is the phrase often used when they issue loans or purchase assets.
Whoa, hang on, out of thin air.
It's a process very similar to how central banks create reserves. When a bank approves your loan, they're not necessarily pulling from existing deposits. They're simply adding a new balance to your account. That deposit is the loan proceeds.
So the majority of the money I see in my bank account didn't exist before the bank decided to lend it to someone or maybe buy a bond.
That's largely correct for the system as a whole.
Yeah.
The act of lending creates the deposit.
Wow, okay. So money is being created with a few computer entries, but then what if everyone suddenly wants to withdraw their money at the same time, like a bank run? Wouldn't the banks, run out?
That's where fractional reserve banking comes into play. Banks are only required to hold a fraction of their total deposits as reserves. To handle potential withdrawals, they use their existing reserves, or they borrow reserves from other banks in the interbank market, or they could even borrow directly from the Fed as a last resort.
Okay.
Of course, while bank deposits are the most common form of money for us, they're fundamentally created by the private sector and thus carry a different kind of risk profile compared to, say, central bank reserves or physical currency.
A different risk profile. But what about things like government deposit insurance, like the FDIC? Doesn't that make them safe?
Historically, yes, the risk profile was quite different. Remember, bank deposits are a creation of the private banking system, and there have been periods with widespread bank failures. Absolutely. But government measures like deposit guarantees, stricter regulation, and the Fed's ability to provide emergency loans have significantly mitigated that risk in our modern system. So yes, they've made bank deposits very safe for most practical purposes today.
Okay, so we've got fiat currency, central bank reserves the digital cash for banks and bank deposits, the everyday money that's mostly created through lending. What's the next piece of the puzzle here?
Next, we have treasuries, U.S. treasuries. These are essentially IOUs issued by the U.S. government. They pay interest and, importantly, can be easily converted back into bank deposits by selling them in the market or using them as collateral to borrow.
So they're very liquid.
Extremely liquid,
Yeah.
especially the short-term ones. Wang describes them as effectively money for large investors. If you're a big institution managing significant funds like a pension fund or a corporation, a large portion of your liquid holdings will likely be in treasuries.
Okay, so different forms of money tailored to different parts of the financial ecosystem. That makes sense. Now, the idea of central bank digital currencies or CBDCs has been getting a lot of attention lately. Where do they fit into this picture?
CBDCs. A CBDC would be a digital form of a nation's fiat currency, issued and directly controlled by the central bank. So it would be like reserves, but potentially available to the general public, not just banks.
Okay.
Governments see potential benefits in terms of maybe payment efficiency and potentially greater control over monetary policy. However, for individuals, there are significant considerations, particularly concerning privacy, because the central bank would potentially have a direct record of all transactions.
Yeah, that privacy angle always comes up. Definitely some big implications there. Let's circle back to fiat currency for a moment. Wang mentions a rather surprising statistic about $100 bills.
Oh yeah, this is fascinating. What's quite striking is that despite the increasing prevalence of digital payments, the total amount of physical U.S. currency in circulation has actually been on the rise, especially the big bills.
More cash, even now.
Yes. And the data strongly suggests that the majority of these $100 bills are likely held outside of the United States.
Held abroad. That
Yeah.
seems counterintuitive. Why would that be?
There are a few key reasons. In countries facing economic instability or high inflation, individuals often prefer to store some of their wealth in stable, globally recognized currencies, like the US dollar. It's a safe haven asset.
Right, outside their own system.
Exactly. And potentially outside the direct scrutiny of their own governments. In some extreme cases, countries have even completely adopted the US dollar as their official currency dollarization, effectively outsourcing their monetary policy to the Fed.
Interesting. Okay, so how does all this money we've been talking about actually get created? We touched on bank loans creating deposits, but let's dig a bit deeper into the mechanics.
Let's really unpack these money creation mechanisms. As we mentioned, commercial banks are key players in creating money through lending. Imagine a simplified balance sheet for a bank, okay? When a bank approves a $1,000 loan, it simultaneously adds $1,000 to the borrower's deposit account.
Yeah.
So on the asset side, the bank now has a $1,000 loan receivable. On the liability side, it has a new $1,000 deposit it owes to the borrower.
Okay, I see. It's like the numbers just appear on both sides of the ledger at the same time. Asset and liability created together.
Precisely. What about the Fed and those central bank reserves? How do they get into the system?
Right. How does the Fed inject this base money?
The Fed creates central bank reserves when it purchases financial assets like those treasury securities we were just discussing, or when it extends loans directly to banks through things like the discount window.
So QE, for example, quantitative easing.
Exactly.
Yeah.
That's a prime example. If the Fed buys, say, $1 billion worth of treasuries from a commercial bank, the bank's balance sheet changes. Its treasury holdings go down by $1 billion, but its reserve account at the Fed goes up by $1 billion.
Okay, so it swaps one asset for another, more liquid one, basically.
You got it. And what happens if the Fed buys those treasuries from someone who isn't a bank, say a large corporation or a pension fund?
Good question. How does that work?
The mechanics are slightly different, but the net effect is still an increase in reserves within the banking system. If a corporation sells $1 billion in treasuries to the Fed credits the reserve account of the commercial bank where that corporation holds its deposits.
Ah, okay.
The commercial bank, in turn, sees its reserves go up at the Fed, and it increases the corporation's deposit balance by $1 billion. So the commercial bank ends up with more reserves balanced by a higher amount it owes to its corporate depositor. The corporation has cash instead of treasuries.
But so these reserves don't just disappear after a transaction then, they just move around between banks.
Exactly. Central bank reserves technically never leave the Federal Reserve's overall balance sheet. They simply move from one commercial bank's account at the Fed to another's as those banks settle payments between themselves or with the Treasury or other Fed account holders.
So if that corporation pays a supplier.
Right. If that corporation we talked about makes a payment to a supplier who banks at a different institution, the reserves simply shift electronically from one bank's reserve account to the others at the Fed. The total amount of reserves in the system hasn't changed, just who holds them.
Okay, that's clear. So commercial banks create deposits when they make loans, and the Fed creates reserves when it buys assets or lends. Now let's circle back to treasuries again. How do they play into this whole money creation process? Because the Treasury issues them, not the Fed or banks.
Right. The U.S. Treasury effectively creates money, in a sense, when it issues Treasury securities. When an investor buys, say, $100 worth of newly issued Treasuries, they typically use $100 that was sitting in their bank deposit account to make the purchase.
Okay, so money moves from a deposit account to the Treasury.
From the investor's perspective, yes. From the Treasury's perspective, it has now borrowed $100, and its account at the Federal Reserve goes up by $100 in reserves, which came from the investor's bank.
And what happens when the Treasury then spends that borrowed money on, say, Social Security or military salaries?
Let's say the Treasury uses that $100 to pay a doctor for services provided through Medicare. The Treasury's reserve account at the Fed decreases by $100. The doctor's commercial bank receives those $100 in reserves from the Fed, and that bank, in turn, increases the doctor's bank deposit by $100.
Ah, so the reserves flow back into the banking system.
Exactly. So while reserves flow back into the banking system and deposits increase in one place, the doctor's account, they initially decreased somewhere else, the investor's account, when the investor bought the Treasury. The total amount of reserves and deposits in the system remains largely the same at that precise moment of spending, but the amount of outstanding Treasury debt has increased by $100.
Okay, that's a crucial point. The debt increases. Now, unlike reserves, which are backed by the assets the Fed buys, or bank deposits, which are essentially backed by the loans banks make, what provides the backing for treasuries? What's behind them?
That's a really key distinction. Treasury securities are essentially unsecured debt. Their backing rests purely on the confidence in the U.S. government's ability and willingness to repay its obligations, its full faith and credit.
So just confidence.
Fundamentally, yes.
Hmm.
And as Wayne points out, the total amount of outstanding Treasury securities has been on a long-term upward trend, a very significant upward trend.
Which naturally leads to the question many people have. With government debt constantly growing, are we heading towards some kind of financial cliff or crisis? Is there a limit?
It's certainly a concern that many economists and citizens share. You hear it all the time. However, Wang draws attention to countries like Japan, which have a significantly higher level of government debt relative to the size of their economy, their GDP, than the U.S. does.
Much higher, yeah.
And yet, their interest rates on government bonds, the yields, have remained remarkably low for a very long time. Decades, really.
So the market isn't demanding high rates despite the high debt.
Exactly. This suggests that the limits of government debt and its impact on the economy are perhaps more complex and less straightforward than some simple models might predict. Other global factors, like savings flows and investor demand for safe assets, are clearly at play. It's not a simple equation.
That's a really interesting counterpoint about Japan. Now, the term shadow banks sounds a bit mysterious, maybe even risky. What exactly are these entities Wang talks about?
Shadow banks are essentially financial entities that operate outside the traditional realm of regulated commercial banks, but they perform many similar banking-like activities. Crucially, they take on both liquidity risk, the risk of not having enough cash on hand when needed, and credit risk, the risk that borrowers won't repay.
Just like regular banks do.
Just like regular banks. They do this by extending credit or purchasing assets. However, a key difference is how they fund themselves. They don't gather deposits from the public in the same way, insured deposits. Instead, they rely heavily on borrowing from investors in the financial markets, short-term funding markets, often.
So they're not creating the deposits we use daily, but they're acting as intermediaries, connecting borrowers and lenders using market funding.
That's a good way to put it. They are major intermediaries.
Can you give us some concrete examples of these shadow banks so we can picture them better? It sounds like a broad category.
Absolutely. It's definitely a diverse group. The category encompasses a wide array of institutions, including things like money market funds, hedge funds, exchange-traded funds, ETFs, mortgage real estate investment trusts, or REITs, various private investment funds, and the different entities involved in securitization, like special purpose vehicles, SPVs.
Okay, a pretty varied bunch. And how do the regulations governing these shadow banks compare to those for traditional commercial banks? Are they lighter?
Generally, yes. Shadow banks typically face a less stringent regulatory environment compared to commercial banks. They usually don't have the same strict capital requirements, for instance. And critically, they lack direct access to the Federal Reserve's discount window for emergency borrowing, nor do their investors benefit from FDIC deposit insurance.
So that lighter regulation allows for maybe more flexibility or innovation, but it also implies a potentially higher level of systemic risk, right? less of a safety net.
Precisely. There's a trade-off there. Less safety net is a good way to think about it.
Okay, so they're operating with a different kind of safety net, or perhaps a less substantial one. Now, Wang mentions primary dealers. Who are these players and what role do they play in the system? They sound important.
They are extremely important. Primary dealers are a select group of large financial institutions, mostly big banks and securities firms, that have a special direct relationship with the Federal Reserve.
A special relationship. How so?
They are the only entities that are allowed to trade directly with the Fed in its open market operations. So when the Fed buys or sells those Treasury securities we've been discussing to influence interest rates and the money supply, it does it through the primary dealers.
Ah, okay. They are the Fed's counterparties.
Exactly. They are a critical conduit for the implementation of the Fed's monetary policy. They bid in the Treasury auctions, too.
And do they do more than just trade with the Fed?
Oh, absolutely. They also play a vital role in providing liquidity to other participants in the financial system, including many of those shadow banks we just talked about. If a hedge fund or an ETF needs to quickly access cash, they often turn to a primary dealer.
How? What do the dealers do?
They might either buy some of the hedge fund's assets outright, or, more commonly, they'll lend against those assets through repurchase agreements, which everyone calls repo.
Repo, right. That's like a short-term pawn shop for financial assets, almost.
Kind of, yeah. It's essentially a very short-term collateralized loan. You sell a security today with an agreement to buy it back tomorrow or very soon at a slightly higher price. That difference in price is the interest.
Got it. And repo markets are huge, right?
Absolutely enormous and vital for funding. Which brings us to something Wang mentioned, a notable spike in repo rates back in September 2019. What exactly happened there?
Yeah, the 2019 repo spike, that was a big deal. Essentially, there was a sudden and significant jump in the interest rates for these overnight repo loans. It became very expensive very quickly to borrow overnight.
Why? What caused it?
A confluence of factors, it seems. Things like corporate tax payments draining cash from the system and a large settlement of new Treasury debt pulling reserves out of banks. The bottom line was that primary dealers and many other financial institutions who rely heavily on repo for daily funding experienced a temporary shortage of available cash to lend at reasonable rates.
So the plumbing got clogged, basically.
That's a perfect analogy. It highlighted just how much these institutions depend on smooth functioning in these short-term funding markets. And because many shadow banks were also active borrowers in the repo market, the Fed had to intervene.
How did the Fed step in? They stepped in quickly by injecting liquidity directly into the repo market, offering large overnight loans, again, through the primary dealers. This calmed things down and stabilized rates.
So by providing funds to the primary dealers, the Fed ensured that the dealers could continue to lend to the broader market, including those shadow banks that were feeling the squeeze, even though the Fed wasn't lending directly to the shadow banks.
That's the essence of it. It was indirect support. By acting through the primary dealers, the Fed addressed the immediate funding pressures and helped to prevent wider disruptions in the financial system. It showed how interconnected everything is.
Definitely. Okay, let's delve into some of these shadow banks in more detail now. First up are money market mutual funds, MMFs. They sound relatively safe, right? Like a place to park cash.
Yes, money market funds, or MMFs, are investment funds specifically designed to provide investors with safety, liquidity, and a modest return. They're often viewed as very close substitutes for traditional bank deposits.
The goal is stability, keeping the value at $1 per share.
Exactly. The general expectation is that you can put $1 in and reliably withdraw $1, plus a little bit of interest. However, this fundamental assumption was severely tested during the 2008 global financial crisis.
What went wrong? I remember hearing about funds breaking the buck.
That's exactly it. One of the largest money market funds at the time, the Reserve Primary Fund, held a significant amount of short-term debt, commercial paper, issued by the investment bank Lehman Brothers.
Ah, Lehman.
When Lehman collapsed, that debt became worthless, causing losses for the Reserve Primary Fund. These losses were large enough to cause the fund's net asset value, its share price, to fall below $1. It broke to the buck.
And that caused panic, I assume.
Big time. It triggered a widespread panic among investors, leading to a massive run on other prime money market funds, those that invested in corporate debt, not just government securities. Investors feared similar losses elsewhere and rushed to pull their money out.
That sounds like it could create a lot of instability across the system.
It certainly did. Prime MMFs were huge buyers of commercial paper, which is short-term debt issued by banks and corporations. As investors fled the MMFs, the funds were forced to stop buying this paper or even sell what they held.
So the funding market for banks and companies dried up.
Precisely. Banks and corporations suddenly found it much harder and more expensive to borrow short-term. This in turn raised serious concerns about the financial health of some banks, further escalating the panic throughout the financial system. It was a major domino effect.
Wow. Okay, next on our list of shadow banks are exchange-traded funds, or ETFs. These are hugely popular now. How are they classified as shadow banks? They just trade like stocks, don't they?
Well, yeah, shares of ETFs are bought and sold on stock exchanges just like regular stocks, but they represent ownership in an underlying portfolio of assets, stocks, bonds, commodities, whatever the ETF tracks.
Right.
The key mechanism that connects them to the underlying assets and keeps their price in line is the creation and redemption process. Large institutional investors, called authorized participants or APs, can bundle up the actual underlying assets, like all the stocks in the S&P 500, and exchange that basket with the ETF provider for newly created ETF shares.
Okay, they create new shares from the assets.
And conversely, they can take a large block of ETF shares and redeem them back to the provider in exchange for the underlying assets. This arbitrage process helps keep the ETF's market price very close to the net asset value of its holdings.
So why shadow banking?
They are considered part of the shadow banking system because, while their shares trade like equity, they're essentially facilitating investment in and providing liquidity for other asset classes in a way that bypasses traditional bank balance sheets. They perform a kind of liquidity transformation similar to banks, but using market mechanisms and without deposits.
I see. It's about the function they perform in the system. What about private investment funds? This would include hedge funds and private equity firms, right? What's their role in this shadow world?
Yes, that's correct. Private investment funds, like hedge funds and private equity, typically operate by raising capital from sophisticated investors and then investing it according to specific strategies. Their funding model varies.
How so?
Many borrow capital, often using prime brokers, for a medium-term duration, and then invest those funds in assets with a longer-term horizon, maybe making bets on price movements or buying companies. This structure, borrowing medium-term to invest long-term, can help reduce the risk of being forced into fire sales if investors suddenly want their money back.
But not always.
Right. Some private investment funds, particularly certain types of hedge funds, using a lot of leverage, do employ shorter-term borrowing strategies, often in the repo market we discussed. This can make them vulnerable if their lenders get nervous and decide not to renew or roll over those loans when they come due. Liquidity risk again.
Okay. And then there's securitization, which you mentioned earlier, played such a significant role in the 2008 financial crisis. Can you unpack that process a bit more in this context?
Sure. Securitization is the process of taking a pool of relatively illiquid assets. The classic example is residential mortgages, but it could be auto loans, credit card receivables, student loans, almost anything with a cash flow, and repackaging them into new securities that can then be sold to a wider range of investors.
So turning loans into bonds, essentially.
Essentially, yes.
Yes.
While securitization itself isn't inherently bad, it can increase liquidity and broaden access to different asset classes for investors. Its widespread adoption, especially with mortgages, fundamentally altered the business model of many commercial banks leading up to the 2008 crisis.
How did it change their model?
Instead of the traditional originate-to-hold model, where banks made loans and kept them on their own balance sheets, earning the interest over time, many shifted to an originate-to-distribute model. They focused on making loans, sometimes with looser standards, unfortunately, and then quickly selling them off through this securitization process, booking upfront fees. The risk was theoretically passed on to the investors buying the securities.
Theoretically, but maybe not actually, as 2008 showed.
Precisely. The complexity and opacity of some of those securities meant the risk wasn't always well understood or managed.
We also have asset-backed commercial paper, or ABCP. What's the function of that? Sounds related to securitization.
It is related. Think of ABCP as a type of very short-term debt, commercial paper, that is issued by special legal entities called conduits. These conduits use the money raised from selling the ABCP to buy various types of assets.
What kind of assets?
It could be pools of loans, receivables, or even longer-term assets like mortgage-backed securities. So it's conceptually similar to how a traditional commercial bank funds its lending activities using short-term borrowing in the money markets, but it's done off bank balance sheets through these conduits. They continuously issue and roll over this short-term ABCP debt to fund their longer-term asset holdings.
And this also experienced a moment of crisis during the run-up to 2008, didn't it? Before Lehman, even.
Yes, absolutely. The ABCP market experienced a severe contraction, really a panic, beginning in the summer of 2007. This was triggered in part by the bankruptcy of a large mortgage originator called American Home Mortgage.
Okay.
This event raised widespread concerns about the quality of the underlying assets being financed by ABCP, particularly subprime mortgages hidden within these structures. Investors suddenly became very unwilling to purchase or roll over their investments in ABCP.
So the funding dried up for these conduits.
Exactly. The market seized up. And this then had major knock-on effects for the commercial banks themselves. Why? Because many banks had provided guarantees or other forms of credit enhancement, like liquidity backstops, to these ABCP programs they sponsored.
Ah, so they were on the hook.
They were on the hook. When the ABCP funding dried up, the banks were contractually forced to step in and either finance the underlying assets themselves or take them onto their own balance sheets, which put huge pressure on their capital and funding. It was one of the first big signs of this systemic trouble brewing.
It really highlights how interconnected all these different parts of the financial system are, doesn't it? And how a problem in one seemingly obscure corner can quickly spread. Now, let's talk about Federal Home Loan Banks, or FHLBs. The name suggests they have a connection to the government.
They do indeed. They are government-sponsored enterprises, or GSEs, similar in structure to Fannie Mae and Freddie Mac before their conservatorship.
GSEs, right.
While they're technically structured as cooperatives, owned by their member institutions, mostly banks and credit unions, and are not directly part of the federal government, they are widely perceived by the market to have an implicit government guarantee.
Meaning the government would likely step in if they got into trouble.
That's the general assumption, yes. And unlike purely private corporations, their primary mission is not profit maximization, but rather to support public policy goals, specifically in the area of housing finance and community lending. The FHLB system was established way back during the Great Depression, actually.
What's their main function today?
Their main function is to provide a reliable source of funding, called advances, to their member banks and other institutions. This funding, in turn, is intended to support mortgage lending and community development.
So, in a way, they act as a bank for banks, specifically those involved in housing finance. Is that fair?
That's a good analogy, yeah. They primarily borrow funds themselves, mostly on a short and medium-term basis in the capital markets, issuing debt that's seen as very safe because of that implicit guarantee.
Which means they can borrow cheaply.
Exactly. They can typically borrow at very low interest rates,
Yeah.
often just slightly above Treasury yields, and then they lend those funds, the advances, to their member banks at slightly longer terms, passing on some of those cost savings.
And this is important for banks.
It makes them a crucial and often significant source of funding for banks, especially during periods of financial stress when other funding sources might dry up. Interestingly, as Wang notes, banks often prefer to borrow from the FHLBs before resorting to the Fed's discount window.
Why is that?
There's less of a perceived stigma associated with borrowing from the FHLBs. Going to the Fed's discount window is sometimes seen as a sign of weakness, whereas borrowing from your FHLB is often viewed as more routine business.
Interesting dynamic. Okay, we've covered a lot of ground within the U.S. financial system, but Wang also dedicates significant attention to the offshore dollar market. What exactly is that? It sounds, well, offshore.
It is exactly that. The offshore dollar market, sometimes called the euro dollar market, though it's much broader than Europe now, refers to banking and capital market activities. So deposits, loans, bonds that are denominated in U.S. dollars but take place outside of the United States.
So a Japanese bank lending dollars to a Korean company, for example.
Perfect example. That's pure offshore dollar activity. And it's a vast and incredibly significant market, involving trillions and trillions of dollars in borrowing and lending, primarily by non-bank entities and banks residing outside the U.S.
Trillions. Bigger than I might have guessed.
Oh, yes. In fact, Wang emphasizes that the size of the offshore dollar market significantly exceeds the offshore demand for other major currencies, like the euro or the Japanese yen. The dollar's global role is just dominant.
Why, though? Why does this huge offshore dollar market even exist? Why wouldn't these entities just borrow and lend in their own local currencies, euros, yen, whatever?
There are several really compelling reasons for this strong international demand for dollars. Firstly, a huge portion of global trade, especially commodities like oil, is conducted and invoiced in U.S. dollars, even in transactions where neither the buyer nor the seller is a U.S. entity.
So you just need dollars to do business internationally.
You often do, yes. It creates a natural constant need for dollars to facilitate international commerce. Secondly, many countries around the world either explicitly peg their currency's value to the US dollar or closely manage their exchange rate against it. Think of places in the Gulf or Hong Kong. This leads to central banks and commercial entities needing to hold significant dollar reserves.
Right, to manage the peg.
Thirdly, interest rates on dollar-denominated loans or bonds can sometimes be more attractive, either cheaper for borrowers or offering better returns for lenders than those available in local currencies, depending on market conditions. And finally, maybe most importantly, the U.S. dollar capital markets, particularly the market for U.S. Treasury securities, are exceptionally deep and liquid, just unparalleled. This makes it much easier for large borrowers to raise substantial amounts of capital and for investors to readily buy and sell assets without moving the price too much.
So it's a combination of convenience for international trade, stability due to currency pegs, potentially lower borrowing costs, and just the sheer size and liquidity of the U.S. markets that everyone trusts.
Precisely. And related to that liquidity point, holding dollars, especially in the form of highly liquid U.S. Treasuries, is also incredibly attractive for foreign central banks, corporations, and wealthy individuals as a safe and easily convertible store of value.
Right.
Wang highlights this. Even a country like China holds massive amounts of U.S. Treasury debt, trillions of dollars worth. In part, it's because there simply isn't another market in the world with sufficient depth and liquidity to absorb such enormous holdings safely. Where else would they put it?
That's a staggering thought. Now, why is this financial activity happening specifically offshore? What's the advantage or historical reason for being outside U.S. borders for these dollar transactions?
Historically, a significant driver for the initial growth of the offshore dollar market, the eurodollar market back in the 60s and 70s, was regulatory arbitrage. Banks operating outside the United States, like in London, weren't subject to the same U.S. regulations, particularly Regulation Q, which capped deposit interest rates, and reserve requirements.
Avoiding regulations.
Essentially, yes. It gave them a competitive advantage in offering dollar-denominated deposits and loans. While many of these specific regulatory differences have narrowed significantly since then, especially post-2008 crisis,
The market persists.
the market absolutely persists. The pure cross-border flows that Japanese bank lending dollars to a Korean company remain substantial and now constitute the dominant part of the market, driven by those fundamental economic reasons we just discussed, not just regulation.
Are there any notable differences in who participates in the offshore dollar market compared to the domestic U.S. market? Does it serve different clients?
Yes, that's an important distinction Wang makes. The offshore dollar banking world primarily serves large corporations, financial institutions, sovereign wealth funds, central banks, basically sophisticated institutional players.
Not so much regular people or small businesses.
Generally not. Whereas the domestic U.S. market, of course, caters to everyone, including retail clients and small businesses. This distinction makes offshore funding potentially more susceptible to sudden withdrawals or runs during times of crisis.
Why is that?
Because institutional investors, who are the main depositors and lenders in the offshore market, manage huge sums, far exceeding any government-backed insurance limits, which usually don't exist offshore anyway.
Right.
They tend to move their capital very quickly at the first signs of trouble in a counterparty or the market. They're less sticky than retail depositors.
More prone to run.
Got it. So what role does the U.S. Federal Reserve play in this global offshore dollar system? Does it just ignore it because it's offshore?
Oh, definitely not ignore it. Despite this activity taking place offshore, the Fed has effectively become the ultimate lender of last resort for the entire global dollar system, whether it likes it or not.
How does that work?
During major crises like the 2008 financial crisis, and again during the 2020 COVID-19 market turmoil, there were severe shortages of U.S. dollars in these offshore markets. Foreign banks and companies were scrambling to get their hands on dollars to meet their obligations.
A global dollar crunch.
Exactly, and the Fed had to step in. It did this primarily by providing crucial dollar liquidity to foreign central banks through the activation and expansion of foreign currency swap lines.
Swap lines, what are those? Essentially, the Fed lends dollars to a foreign central bank, like the European Central Bank or the Bank of Japan, in exchange for an equivalent amount of their currency. The foreign central bank can then lend those dollars out to commercial banks within its own jurisdiction that desperately need them.
So the Fed backstops the whole global system indirectly through other central banks.
That's the mechanism. It alleviates those global dollar funding shortages and prevents a potential cascade of defaults and a wider financial meltdown spilling back into the U.S. It underscores just how central the dollar, and therefore the Fed, is to the entire global financial architecture.
It really sounds like the Fed's influence and responsibility extend far, far beyond U.S. borders when it comes to the global role of the dollar. Incredible. Okay, let's shift our focus slightly now to interest rates. Wang states, pretty simply, that they are fundamental to the pricing of all assets.
That's absolutely correct. It's one of the most basic tenets of finance. Interest rates essentially represent the cost of borrowing money or the return on lending it. You can think of them as the price of time, in a way.
The price of time, I like that.
In the U.S. financial system, and really globally, the yields on U.S. Treasury securities serve as the foundational benchmark. They are often considered the risk-free rate, although maybe risk-free is too strong a word. Let's say very low risk.
Right, the baseline.
Exactly. The baseline against which the expected returns, and therefore the prices, of all other investment stocks, corporate bonds, real estate, everything, are evaluated. Investors look at the yield they can earn on a relatively safe Treasury bond and then demand a higher potential return, a risk premium, for investing in assets with greater perceived risk.
Makes sense. You need to be compensated for taking more risk than holding a treasury. And as we discussed earlier, the Fed primarily controls the very short-term interest rates, while market forces play a much bigger role in determining longer-term rates, right?
Generally speaking, yes. The Federal Reserve's main levers of influence, its policy tools, are most directly targeted at short-term overnight interest rates. Primarily through things like the interest rate it pays on banks' reserve balances held at the Fed, that's IORB, and the offering rate on its overnight repurchase agreement facility, the ONRRP. Those anchor the very front end of the yield curve.
Okay, the overnight stuff.
Right. Longer-term interest rates, however, like the yield on a 10-year or 30-year Treasury bond, are influenced by a much wider array of factors. Market expectations about where the Fed will set short-term rates in the future are huge.
What else?
Also, expectations about future inflation lenders want to be compensated for inflation eroding their returns. And of course, the overall supply and demand dynamics for Treasury bonds themselves, including buying by foreign central banks or big institutional investors. The Fed can influence longer rates through things like QE, but it's less direct control.
Okay, got it. Finally, let's touch upon crisis monetary policy. Wang details how the severity and, importantly, the nature of the 2008 financial crisis compelled the Federal Reserve to venture way beyond its conventional policy tools.
Yes, the 2008 crisis was a watershed moment. The unprecedented panics that unfolded, particularly in the shadow banking system, the run on money market funds, the seizure in the ABCP market, and also in those offshore dollar markets we discussed.
Right, areas outside traditional banking.
Exactly. It revealed that a substantial critical portion of financial activity was taking place outside the traditional regulated commercial banking sector. These were areas largely beyond the direct reach of the Fed's conventional monetary policy instruments, like the discount window or adjusting the Fed funds rate target.
So the old tools were enough.
They weren't hitting the right spots or weren't powerful enough. To prevent a complete collapse of the financial system, which seemed terrifyingly possible in the fall of 2008, the Fed had to invoke its emergency lending powers. These are authorized under Section 13 of the Federal Reserve Act for unusual and exigent circumstances.
Section 13(3). That allows them to lend more broadly.
Yes. Critically, it allowed the Fed, with approval from the Treasury Secretary, to provide liquidity support, to lend to a much broader range of institutions and markets than just commercial banks. This included lending directly to primary dealers, setting up facilities to backstop money market funds, and supporting the markets for commercial paper and asset-backed securities like those involved in securitization.
So the Fed essentially had to become the lender of last resort, not just to banks, but to critical markets and non-bank financial institutions to prevent a systemic meltdown.
Precisely. It was a massive expansion of its role. And as we discussed earlier regarding the offshore market, they also established and dramatically expanded those crucial central bank swap lines with foreign central banks to address the severe global shortage of U.S. dollars. That was another huge unconventional step.
And beyond these emergency lending facilities, other unconventional policies emerged too, right? Like forward guidance and QE.
Absolutely. These became central. Forward guidance is where the central bank explicitly communicates its intentions about the future paths of interest rates, like saying, we expect to keep rates near zero for an extended period. The goal is to influence longer-term rates by shaping market expectations.
Managing expectations.
Exactly. And then large-scale asset purchase programs, universally known as quantitative easing or QE, became a primary tool. Here, the Fed buys large quantities of assets, mostly treasuries and mortgage-backed securities, financed by creating central bank reserves. The aim is to directly lower longer-term interest rates and ease financial conditions when short-term rates are already at zero.
And now these unconventional policies from 2008 seem to have become almost standard practice in responding to subsequent economic downturns, like in 2020.
That's very true. The playbook definitely expanded.
Mhm.
Wang even mentions yield curve control, or YCC, as another potential tool that has been discussed, though not fully implemented in the U.S.
Yield curve control, what's that?
That's where a central bank goes a step further and announces specific target levels for interest rates, not just overnight, but further out along the maturity spectrum, say, targeting the 3-year or 5-year bond yield, and then actively buys or sells bonds as needed to enforce that target. The Bank of Japan has done this.
Wow, even more direct intervention.
Okay, finally, Wang concludes with a really interesting, perhaps provocative point. He questions the long-held belief that lowering interest rates always and unequivocally stimulates economic growth. He points to some data suggesting a more complex and sometimes even positive correlation between rates and growth. That's a bit of a head-scratcher.
It is quite counterintuitive to traditional economic thinking, isn't it? The
Right.
standard view is lower rates, cheaper borrowing,
Right.
more investment and consumption, higher growth.
Right. Econ 101.
But Wang raises the important point that while lower interest rates can certainly encourage some forms of borrowing and investment, the effectiveness of this mechanism might diminish significantly when rates are already very, very low, near zero or even negative. Maybe the boost gets smaller and smaller.
Diminishing returns.
Possibly. And he also notes the experiences of places like Japan and the Eurozone, which actually implemented negative interest rates on central bank reserves. The evidence there is ambiguous at best regarding the impact on real economic growth.
What did it impact then?
The evidence suggests these ultra-low and negative rate policies may have had a much more significant impact on boosting financial asset prices, stocks, bonds, real estate, than on generating robust, sustainable growth in the real economy, like business investment or wages. It raises questions about who really benefits and whether the traditional policy levers work the same way in today's world.
That's a really important question to ponder. Okay, so to try and bring it all together for you, our listener, we've taken quite a journey, a real deep dive into the different forms of money in our financial system: fiat, reserves, deposits, treasuries.
We explored how money is created, both by commercial banks making loans and by the Federal Reserve buying assets or lending.
Right, and we examine the vital and sometimes complex roles of various financial institutions that operate alongside or outside traditional banks, that whole shadow banking system, including MMFs, ETFs, hedge funds, and the securitization process.
We also looked at the crucial role of primary dealers, the repo market, the FHLBs, and the vast offshore dollar market, highlighting how interconnected and globalized finance really is.
And finally, we touched on how central banks like the Fed use interest rates and have adapted their policies, especially during crises, employing tools that were once considered unconventional. Hopefully, you now have a much clearer and more foundational understanding of this often complex ecosystem.
We certainly trust this deep dive has provided you with those valuable aha moments you might have been seeking, illuminating aspects of the financial world that can often seem opaque, maybe deliberately so sometimes, and difficult to grasp.
Absolutely. And as we've seen today, each of these areas we touched on, from the intricacies of shadow bank funding and regulation, to the sheer scale and implications of the offshore dollar market, to the ongoing debates about the effectiveness and consequences of Fed policy, could easily be explored in even greater depth in future discussions.
Indeed, this is truly just scratching the surface in many ways. It's a dynamic, constantly evolving system. Perhaps here's a final thought to leave you with, building on Wang's insights. Consider the inherent tension between stability and innovation in this financial system.
Stability versus innovation.
Yeah. The rise of shadow banking, for instance, clearly offered new avenues for financing and investment, potentially increasing efficiency. But as 2008 starkly demonstrated, it also created new pathways for risk to build up and spread, often outside the traditional regulatory perimeter. So the big question remains, how do we, as a society, best strike that delicate balance between fostering beneficial financial innovation and ensuring the overall stability and resilience of the system, especially as it continues to evolve with new technologies and players?
That is the multi-trillion-dollar question, isn't it? Something definitely worth thinking about.